psychology is the most important aspect of trading, right? Because you can have a shit strategy and still break even. You can have a shit strategy and still make a little bit of money. The best way to do it is to have a high probability strategy, right? To have a highly methodical, mechanical approach. Yes, some subjectivity lies. It's important to understand when you're able to actually use subjectivity. Realistically, in order to become profitable, you need to make sure that you master psychology. I'm just gonna give it to you straight. The reason why most of you guys lack when it comes to psychology isn't because you have a shit strategy or it's because you're not built for trading. It's because you cannot justify everything that you've done on the charts. What do I mean? You're listening to people who tell you, let price play into random points of interest, or they mark out liquidity, which is everywhere on the market, and they say, okay, when you see liquidity, look for price to move opposite, blah, 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 yada, yada, yada. You need to have a mechanical and methodical approach. What types of liquidity are you looking for? What institutional zones are you targeting? And you need to make sure that you eliminate and remove all of the fluff that you've learned over the past few years, over the past few months, over the past few weeks. You need to take that out of your mind. In order to become a successful trader, what you must do is you must have a methodical approach that has been statistically proven, and you've gotten your results and you've gotten your data in order to prove that your edge actually has positive profit expectancy. Once you've done that, then you can actually look to eliminate performance discrepancy as much as humanly possible. But how do you expect to find out your performance discrepancy when you don't even know your strategy's performance? How do you get your strategy's performance? Well, by gathering data. Right, you gather data, you look at data for the past few years, you find an average over the past few years that you've backtested, and once you've found an average, that's the benchmark that you're going to use in terms of live trading, in terms of forward testing. Anytime you actually take a trade, going to use that as a benchmark. Let's say your strategy has a 60% win rate, which is really, really good, which dependent on your risk to reward is actually really, really good. So understand, you don't need a 90% win rate strategy. Matter of fact, we'll cut the bullshit right now. There's no strategy that's going to give you 90% win rate. You don't have that many resources in order to actually get a 90% win rate strategy. And hell, even the huge institutions and hedge funds, they sometimes don't have a 90% win rate. So why on earth do you think as a retail trader you're going to get that? The only way to make money is by having a methodical and probabilistic approach, right? It's understanding that risk to reward is everything, making sure that you maximize that as much as humanly possible, because in the times that you are right about the direction of the market, you need to make sure that you maximize your profits, right? Markets can either go bullish or they can go bearish. And if you're right, then you want to make sure that you take profit as much as humanly possible. So what that essentially means, with a higher profit factor, if you're risking 1 to 3, you literally only need a 25% win rate to break even. You take 4 trades, you lose 3 and you win 1, that's breaking even. Let's say you're risking $1,000 per trade, you make $3,000, obviously with a 1 to 3 R, you'd need 3 losing trades in order to counteract 1 winning trade. Random distribution plays a huge role in this. Generally, and notice how I'm saying generally, for every 4 trades that you take, you can lose 3 and win 1 and you'll still break even. You shouldn't actually be going into the market with a 25% win rate anyways. You need to make sure that your strategy at least has a 50 to 60% win rate. You do that by really understanding the market, understanding what is the point of institutional supply and demand, what is the point of liquidity, what does all of this mean. And once you crack that code, that's when you'll be able to say, look, I understand why price is moving this way, I understand why I'm looking for price to move into this particular zone, and then react out of it. If you understand market structure, you'll understand the overall trend of the market. When it comes to actually applying a bias, it's going to be significantly easier. You don't apply a bias by simply looking at the market for the day. You look at the higher time frame, you look at your medium time frame, you look at your lower time frame, you conduct multi-time frame analysis. When you do that, you'll see significantly better results, because by doing that, you're giving yourself a much higher probability. But it's also important to understand what you're looking for on the higher time frame, on the medium time frame, on your lower time frame. Have a trading plan. Understand that trading plan is the holy grail. Understand the nature of random distribution. Let's say you've backtested your strategy over the past 4 years and you found that it has a 58% win rate, for example, right? And you start a live account, you take 3 losing trades in a row, and you're like, damn, my strategy doesn't work in a live market. No, your strategy does work. It's just the nature of random distribution. You're not actually able to predict when you're going to take the losses, when you're going to take the wins. You have to understand that in terms of the past 4 years that you've tested, you've probably taken hundreds of trades. With a 58% win rate, that's over hundreds of trades, right? That is the importance of random distribution. That's why the majority of people find themselves profitable, but when it comes to actually applying themselves, they don't actually seem to be profitable. I challenge you to develop a strategy with a good risk to reward and a decent profit factor. You've gotten your statistical data. If you take 20 trades, by the way, when I say take 20 trades, I don't mean take random trades which don't fall into your plan. Follow your plan, follow your risk rules, and if you take 20 trades and they don't end up doing well, come back to me and tell me, hey Mercier, my trading is flawed. Becoming profitable is so much easier than you think. You don't need to overthink. You don't need to have these complex risk management rules, or you don't need to understand philosophy or understand mimesis or understand whatever the case people preach nowadays. You don't actually need to understand that. All you need to do is develop a strategy with a positive profit expectancy, get the results for that, have those analytics that back you, right? Have that data, make sure that you've done your tests, right? And once you've actually done that, you'll naturally become significantly more disciplined. Once you understand that the distribution is completely and utterly random, you're naturally going to give yourself that edge and significantly increase the probability of making money on the charts.